Welcome, listeners. You're listening to the Deeds in the Desert, where real estate investors tune in for the latest news.
Welcome back to Deeds in the Desert. It's the Pat and Carrie show yet again. And we're going to talk about appraisals, why we use them, why we don't, maybe how AI is affecting how we analyze real estate. So, Pat, here we are again. Look at us, getting older.
It's the only thing that's changed.
Nothing's changing.
No.
Although we're both working out now.
A little bit.
Yeah. Feeling good? Feeling stronger?
Better. I wouldn't say
Better.
good. I wouldn't say
Okay.
I'm strong, but I'm stronger.
Yeah. You know, we used to work out a lot.
Yes.
Back in the day.
Yes.
We would go to CrossFit at lunch. Remember that? We
I
didn't
do.
have showers
Mhm.
in the office. It was bad for others, but you know, we were doing it, and we were
Yes.
getting strong.
Yes.
It was
definitely.
fun.
Yeah.
We've also done a little bit of what did we do? Some hot yoga. That was interesting. Remember
Very.
that year you wanted to figure out how to touch your toes?
That's true.
Yeah, that was wild too.
Yeah.
It's crazy how the evolution changes. And now here we are back again working out. Now this time we have to have personal trainers because we have no ambition in life because we're getting older. Right?
Unfortunately true.
Exactly. So we're going to do something with appraisals. We're going to talk about the evolution of appraisals, kind of like our workout strategies. They're changing drastically,
Evolving all the time.
clearly, like cracking knees. I mean, we got it all. We
That's
definitely have
true.
it all. But I guess we have to talk business. They're
Let's
going to
do
make
it.
us talk business. So appraisals.
Yes.
You know, this is kind of a taboo for us. Do we use them? Do we not? Why do we use them? And we've talked about this before, you know, the value of appraisals sometimes, the value of BPOs sometimes. But we ran across something kind of interesting the other day. We had a random BPO that was an odd amount because if we would have gotten an appraiser, it would have been different.
Yeah.
So why do we not use appraisals?
Well, I wouldn't say we don't use them, right? Because there are times we do.
Yeah.
You know, really, the rationale behind it is on the front end, we have to show a third-party opinion of value, a valuation source. That is a requirement that we want to adhere to. And so we will always show that. However, now, where that opinion of value comes from may differ. It may come from appraisal, it may come from a broker's opinion of value, it may come from a different source. The appraisal itself, we typically don't utilize because we have found that they are typically inflated. They're typically overvaluing what the property's worth because that's what they think they want you to show.
Yeah.
But we, as a lender, are going to them for purely a third-party independent opinion of value. We want to know, what do they think the property's worth?
Yeah.
That's their job to know or ascertain what properties would be sold for under normal marketing conditions.
Yeah.
What we found more success with, however, is going to brokers, going to real estate agents and asking them their opinion of value. Because at the end of the day, they're the ones that are actually transacting. They're the ones with the boots on the ground. They're the ones that are actually talking to buyers and sellers on a daily basis. It's much like, I relate it a lot to a food critic. A food critic is a guy that typically or a woman that goes in and critiques your food, but has never operated in a kitchen, has never been a chef, has no idea how this was created, where the ingredients came from, and will critique you on one side of things.
Yeah.
As opposed to somebody that has been involved and is active in the industry.
Yeah.
And so when I go out and get a Yelp review, I prefer to look at not the food critics, but what do other chefs go to? Where do they eat?
Yeah.
That's more important to me. And so it's much like in the BPO side. We want to know where the BPO value is coming from because those are the ones that are actually doing the work, not in this theoretical world of appraisals.
Yeah. No, it totally makes sense. And, you know, we've leaned a lot on BPOs because they're more realistic too. I mean, it's so insane. I mean, we're not appraisers. Neither one of us are appraisers. So, you know, not knocking appraisals by any stretch of the imagination. But what is the premise behind them putting value to it?
Well, the premise is it all got its origination through the lending industry. Lenders who were not privy to different markets wanted to lend in different areas. They needed to know what the value was because they don't know the buyer and they don't know the seller. They don't know if this is truly an arm's length transaction. And so they got involved with appraisers. The appraisal industry got involved to support their endeavors of going to new markets where they didn't know what was transpiring. So appraisers, in theory, are independent third parties that are giving a valuation without knowing the buyer or seller and not knowing if there's any, intricacies associated with their deal, not shown on paper. Unfortunately, with the residential housing community, when you go out and get an appraisal, about 90+% of the time, the appraisal will come in at the exact same dollar amount as the contract, the purchase and sale contract. Now, is that pure happenstance, coincidence, or is that just a lazy appraiser saying, no, yeah, that's good enough. We will put it in. I'll find the data to support that value. So it's not giving the buyer headache or the seller headache, because if either one of those groups hate me, I'm going to get a bad remark on my
and nobody's going to call me
on my company, and I'm not going to get business going forward. So it's just kind of a sham the way it's turned into, to be honest, in my personal opinion. Again, nothing against appraisers themselves. It's just a broken industry.
It is, because, it's super ironic, and you're 100% correct. You've got this sales contract, and that sales contract's only going through if the appraisal is at that value or higher.
Right.
Otherwise, we're going back to the negotiation table over and over and over again. So it's just, sometimes it's easier just to rubber stamp that thing and move on.
Exactly.
But with the BPO, they're looking at other things. They're looking at future growth. They're looking at what's coming into the market. They're looking at who's next door. They're looking at, prior sale. They're looking at so many different things, where appraisers are kind of put into a corner, more or less, and they're not able to look at it from a more macro side of things. And so we're looking at it from macro and micro. We're looking both directions, but this is, in our opinion, unbiased. But we also use BPOs for another reason. What if we had to take back the property?
Right. Are the appraisers going to be the ones helping us to sell that asset, or is it going to be the broker, the real estate agent, who's actually going to help us with that? And so, to your point, we have a built-in kind of network at that point of somebody that has some expertise in the field, has some knowledge base of where things should be transacting, and we have a built-in broker to go to sell it. We also go to them and say, hey, you appraised it or valued it at this number 18 months ago. What changed? Why is it different? Why is it more? Why is it less? Or why is it the same? If it has changed, why? And secondarily, are we going to be able to get out of this for what we have into it? And that's a great built-in marketing strategy, to your point, of another reason why to use brokers over appraisers.
So when you build your network of brokers that you're looking to get an opinion of value, what is the criteria that you look for when you're employing them to do this?
Deal volume. I want to see them doing a lot of deals outside of guesstimating value. I want to see them actually doing transactions, buying and selling real estate. Second is number of years in the industry. I want to know that this isn't their first rodeo, that they've been through market cycles before. And then third, I want to look at what property type we are evaluating and what their expertise is. Real estate is not the same. Single family detached house is not the same as a casino that you see behind us. The appraiser and broker that is giving an opinion of value on that should be different when it comes to those two different types. So we want to go and get the right to the source of the knowledge and get their opinion of value.
Okay. So more or less kind of a little bit of an assessment of value happening for sure, to see if the value of the broker is there as well.
No doubt.
No pun intended.
Nice joke.
Is there value with the broker? They're going to use that later on social. I just know it. Okay, so now we have options, right? Our options are, we can get a broker opinion, an appraiser. We could go to the county assessor's website, I guess, if we wanted to. Which, have you ever used that?
Have we ever used that? I think we have once.
Okay. Were we desperate? Why did we use that?
I don't remember why.
Yeah.
But I'm pretty sure we did do it one time, and I don't remember the rationale behind it.
So how does the county assessor determine value?
They do kind of global appraisals, which is, the average price per square foot or per lot is X. We're going to put that across everything. And they don't really look at the intricacies involved.
Yeah.
Is there a river running through your land and half of it is covered by a flood zone? That probably will have a detrimental effect on the valuation. Is there great ingress egress associated with it? Is there great access, visibility? None of that is really shown on an assessor's appraised value.
Yeah.
Although that's what they call it.
Yeah. So we've got these third parties. We have to have a third party review. Does that preclude us from doing an internal review of value?
No. As a matter of fact, it is something that we get done, and we want to present that to investors because, in theory, it is an independent third party opinion of value. As a lender, as a kind of a broker in the deal, right? We don't really have skin in it. We're matching up lenders, our investors, to borrowers, the people who actually need the money, and just kind of consummating that marriage between the two of them. We have kind of a responsibility to kind of look through those documentations, make sure there's nothing fraudulent going on, and make sure that they're above board and accurate. So one of the ways we do that is kind of doing our own internal opinions of value. When we do that, we don't advertise it to the clients because it could be deemed, not independent. It's not a third party, an arm's length transaction. However, it is something that we want to take a look at, make sure does it pass the sniff test?
Yeah.
Does this feel right? Is there something else going on here? And so, yes, we do run our own evaluations, and we put a lot of onus on that as well. And so sometimes you will see BPOs or valuations come back at extremely high levels or extremely low levels. That doesn't necessarily mean that that's what we believe it to be. And it will usually be indicative of those wild swings in value is we don't believe it to be that high or that low, and it's something kind of in between. And so with those ones that you see advertised at an extremely high rate, it's probably one that we think is actually a little bit lower than that, and so we feel comfortable doing it at the higher rate. Or the ones that are at the really low numbers, the 10s, they're 20% loan to values.
And we're shaking our heads.
We're saying, how in the world did they come up with this? There's no way we would give them 50% of this value. It's not a good deal. And so we'll give them much less than that, and that's why the misnomer in the LTV.
So it's interesting you say that. Let's say we have a BPO that comes in at 17%. Why don't you go get 2 or 3 or 4 more?
We could. But we would also do it on the other side as well.
True.
Right? When there's a 90% LTV, why don't we go out and get it at that
keep
point?
working it to the stage that, it looks like it fits the bill.
Right. And do it just like an appraiser does, which is trying to make both sides of the equation happy. Because we're an independent third party here, right? We're just trying to marry up investors to borrowers. We could do that. And many firms do that.
I'm sure.
However, what's the point? It makes it easier for the salespeople to sell it. It makes it easier for new clients to go in and feel warm and fuzzy about going into the deal. But at the end of the day, it's one person's opinion of value. Plain and simple. That's it.
Exactly.
And so to put so much onus on one piece of information, I think is a little short-sighted, and one that we as investors or even as a company sometimes put a little too much credence in because it is just one piece of the pie.
Absolutely. Which kind of leads you back to, again, it's, who you're working with that really matters, because there's a reason why we have an underwriting department.
Right.
It's not to just review a BPO.
Right.
So there's a lot that's going into the actual review of the asset prior to us ever even getting a BPO. I know damn well, working with you as long as I have, that you're not getting a BPO until you're comfortable with the value.
Right.
Period. Right? We're not going out and being like, hey, well, let's just test the theory. No, we've already tested it through our underwriting process to determine whether or not we feel it's viable to put out as an investment for our investors. Otherwise, there's no need to go get a value. It's already not made the 90% plus that doesn't get approved around here. So something important for individuals to remember, and yes, we're not going out going, all right, we got to get it in between this window, so we're going to go to 4 No, we pay one time, we get one opinion of value, and that's where it sticks.
Right.
But now I'm an investor. I invest in this loan. It was, presented to me at 20% LTV.
Mm-hmm.
And we're in a foreclosure process.
Mm-hmm.
And now all of a sudden, we're butting up against 100% value with sale and 100% of my capital being returned. And I'm not seeing an 80% capital gain. This is why.
This is why. Yeah, this is why. And most of the times it is why because the appraiser, and it's usually appraisers, not BPOs, that we fall into that trap of, have put a arbitrary value on the property that is just unrealistic.
Yeah.
And because it's unrealistic, our investors has anchored to this high valuation that has never been obtainable to really go into the deal.
Yeah.
And so they are usually disappointed of the outcomes when we have to foreclose, that there isn't that 80% buffer of equity there. That's much less going into it.
Okay. So maybe more important in this conversation is not the appraisal, not the broker price opinion. It is our evaluation process and the ratio of loan to value or loan to cost that we are willing to put out to our investors. So what does that look like from an internal process? What approximately is that percentage? And what does it look like and let's take it from acquisition, development to construction.
Yeah, and that's really the key, right? Because each one of those has a different level of risk. With different risk tolerances, the LTVs changed. So let's start on the acquisition side, which is typically the most risky part of the whole process. There's many more unknowns, many more delays that could arise. And because of that, you need to be compensated for that additional risk. One way we can de-risk it is doing lower loan to values and lower loan to costs. So on average, of those three life stages of a project, you will see the lowest loan to value, lowest loan to cost associated with the acquisition loans.
Yeah.
Those currently average 70% of cost or 60% of value.
Okay.
On average. Some of them are a little bit higher, some are a little lower, but that's kind of where it pops out at. On the development side of things or the early construction side of things, you'll see that increase by 5%, so about 65 and 75% to loan to value and loan to cost. And then on the finished product side or true construction loans, you'll see it increase another 5% up to that 80 and 70% numbers.
Okay.
So
Makes sense.
In average, we're at the high 60s in a blended portfolio on a loan to value basis and mid 70s on a low loan to cost basis.
Okay. So that's probably the most important thing that people need to take from this podcast is you may see a BPO or an appraisal higher, lower, etc. They need to stay within our range. They need to consider that range when they're investing with us, knowing that if we have to foreclose on that property, we're looking somewhere between 20 to 25% equity at the time the loan is issued.
That's correct. Things change.
So let's talk about that. Yeah. Things do change.
For the positive and the negative. Usually for the positive, you don't hear about because we don't get any of the upside, right? We are we're here simply to mitigate risk. Because we don't partake in the upside, the one thing we can change is how much downside risk do we have. One way to do that is through the LTV. And so, we will see a process in which the value of the property changes throughout time is easy to see and understand with a construction loan.
Yeah.
It's easy to see and understand that a property that has no house built on it is worth less than a property with a house built on it.
Yeah.
It's understandable. We can see the value creation. Other times, it's not as apparent. The value creation can come through entitlements, can come through zoning and planning, can come through engineering, can come through just general market conditions. What is real estate transacting for in that particular market?
Yeah.
The ebbs and flows associated with real estate valuation can be more macro in nature and therefore something outside of our control, or more micro in nature, such as the density, how many units they're going to get on that particular piece of land. And so we do see that happen quite often, that you will see a negative or positive impact to valuations from the date of original origination to the date of ultimate sale of the asset.
LTV is always moving.
Always.
And that's something we have to remember when we're investing in these types of products. It is always moving. Sometimes, like you said, for the better, sometimes not.
Right.
It really depends on, so many factors. I mean, we could sit here and talk about all of them, but every specific loan is different. And that's something and that's why our investors have choices, right? And when you're investing in a loan, you have a choice of when you invest in that loan: acquisition, development, construction. So read the investment overviews, consider the risk in these investments, because there is risk. But there's a lot of reward too in this. And we've seen that.
Definitely.
Up to this point, what have we funded? $2.3 billion?
I think we're going on 2.4 now.
Oof, $2.4 billion?
Yeah.
What would you attribute your success to?
I think we look at things much different than the average lender does. As you pointed out, we actually have an underwriting department here that we don't just rely on that third-party opinion of value.
Yeah.
Most lenders, whether that's hard money or more institutional, your normal banks and community centers, will rely on a third-party opinion of value. Whatever that number comes in at, they will say that's the value source. We'll give them X percentage on that based on their rudimentary building blocks that they have that are fairly arbitrary, of we do 65% of loan to value or 60% in this region or whatever their arbitrary number is. We'll take a more holistic approach and look at the borrower's asset that we're going to be collateralized by, but also the borrower themselves. So we spend most of our time underwriting that asset. That's where our background is. And at the end of the day, that's where our collateral is, right?
Yeah.
That's the piece that we can foreclose and take back the easiest. So we want to make sure we're surrounded by a blanket of equity.
Okay.
But I would say if there's one key, it's working with the right people.
Yeah.
We have the ability to pick and choose who we work with. And I like to think that we work with good people and good borrowers. These are not people that are out just trying to scam a bank and get money out of them.
Yeah.
These people are ones that I've talked to, I've sat down with, I've seen their projects, I've seen what kind of car they're driving to the property.
Yeah.
I've seen the prior properties that they've done, both successfully and ones that didn't turn out as well. I want to see the good, the bad, and the ugly.
Yeah.
And I like to believe that these are tried, true borrowers that have been through the market cycles, that had been through the 07s, 8s, and 9s when property values got cut in half.
Yeah.
What happened then?
Yeah.
What did they do at that point? So I think a lot of our success is purely just being a middleman. We just deal with really good investors and really good borrowers.
Yeah.
And it's simple as that.
Okay. I don't think I have anything else. But we're gonna mess with our marketing crew behind the cameras right now, because we started this episode. He's over here wondering what's about to happen. He's about to take off his headphones, but he knows well enough that working with Carrie always comes with some hidden gems along the way. So now he's sitting there wondering. So Pat, we started this episode talking about the fact that we started working out.
That's correct.
And I know I'm not as strong as you, but we're going to arm wrestle.
Oh, God.
And they're laughing behind the scenes right now. So I'm going to do an outro first, and then we're going to stand up. And we do have a camera in front of us, so we're going to arm wrestle. But I'm going to get a 3/4 head start. Is that fair?
That's fair.
I mean, it's fair, right?
That's fair.
It's fair. Okay, so.
When is my performance review?
Yeah, I think I missed that, didn't I?
Well, now it's going to be today, I'm guessing.
It's going to be today, right now.
Yeah.
If you win, I'll do your performance review. If you don't win, I'm just kidding. So I'm going to do an outro really quick just so he has it. But and then we'll let him decide which outro he wants to use.
Deal.
So thank you so much for joining us for Deeds in the Desert, where we are talking to Pat Vassar over here as it pertains to the value of assets, what we should consider as investors, maybe what we should consider for loan to value properties, where we want to invest. There's risk and there's reward with every investment. So thank you so much for joining us. We'll see you next time. We started this episode talking about the fact that Pat and I are finally working out again. Finally. We're getting older, but we're still working out. Pat, loan to value, loan to cost. This way, loan to cost. That way, loan to value.
Deal.
Ready?
Let's go.
Set.
Set.
I get to start.
You get start right here.
I get to start here.
Okay.
Ready?
Yeah.
Set. Outro.
Go. Let me know when you want to start.
Go.
Okay. Let me know. Are you going? Or wait, right now we're going? This is live?
This is gonna be a loan to cost.
Oh, loan to cost wins. Loan to cost definitely wins. Not loan to value.
See you next time.
Thanks for joining us this week on Deeds in the Desert, where short-term investments meet long-term investors. We hope you enjoyed the content so much that you share it with all your friends. Who doesn't like learning about passive fixed income, right? Still hungry for more education? Visit our website at ignitefunding.com. Or if you're ready to take the leap and start investing, give us a call at 702-761-0000 and schedule a free investor consultation.